Monday, March 18th. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio today, Seth, Jayson.
Hey. We
both survived St. Patrick's Day.
I didn't even know it was happening.
I was going to say, we weren't really at risk, although...
I quit drinking, so I don't know when since all holidays in the U.S. now seem to involve getting completely plastered.
Not all of them.
Not all of them.
But, any port in a storm, I suppose. We're going to dig into some earnings, and it's earnings in air quotes, and we're gonna talk Uber and Lyft, which are gearing up to go public next month.
You need double, triple air quotes for earnings there.
Yeah. Let's start with Overstock.com. Fourth quarter results were such that stock down around 12% this morning. I'll be honest.
Down a long way over the last couple of years.
Yeah. When I first saw this, my first thought was, I think I had forgotten that Overstock was still around. Overstock, at once upon a time, had carved out an interesting, at least, attempt at a niche, which is, look, people are selling stuff online. People are buying stuff online.
Let's do that, too.
And we're going to do that, and we're going to sell stuff at a discount because inventory management is hard, and you end up with stuff being overstocked.
And it never really ended up being that business, right? That was that was like a microsecond. It just turned into a kind of a regular online retailer. Third-party fulfillment is sort of the way everyone has gone. So you're competing with, eBay, Amazon, AliExpress, Alibaba, everybody, right? So that's a tough business. Not helping Overstock is that Mr. Byrne, my good old friend, we have such a colorful history together.
Patrick Byrne.
I know. He hasn't
CEO.
attempted to destroy me for a long time, so I can't wait for the email.
Well, let's not break that record today.
He can't seem to decide what he wants the company to be. Now, he always tried to get points for direct communication, and my fellow shareholders from this release earns some of that. And it's let's see, our retail arm lost money last year because I gunned things in an attempt to create a conventional high-growth, money-losing e-commerce business, but the losses were nauseating, and we reverted back to the philosophy of profitability. They also are, it's kind of trying to shop the online business. So I guess maybe trying to gun the accelerator and sell more stuff and lose money on it was hopefully a way to attract a nice price for that. But it didn't work out very well. They did spend a lot, if you go through the 10K, on advertising, and it didn't translate into very much of a top-end growth figure. And so they're going back to trying to just at least eke out some cash flow profitability. In the meantime, all of this Bitcoin-ish stuff they've been doing, blockchain-ish stuff, is just really... It's not even the trend anymore. And so that's all housed in something called Medici Ventures, which is, for those who aren't familiar, described in the filings as the strategy is to develop and advance the concept of government as a service and a technological stack for civilization. Now, history note, the Medici weren't never so interested in government as a service. It was always like government at our service, but you don't really realize it. So they've got some sort of interesting ideas, and some of them even sound almost altruistic about, helping Peruvian indigenous people, stay on the land and not let the mining companies have it. But in the meantime, it costs a lot of money and doesn't make any money, and that's where Overstock finds itself right now. Still, maybe we're going to sell our retail business. Maybe we're not. It still says in the filings. So if you buy Overstock stock, you really don't know what you're getting at this point.
So they hired Guggenheim Securities to help them sell off the retail arm. And as you said, this is an online retail company that's trying to pivot to being a leader in blockchain technology.
Which is so 3 years ago now.
And by the way, they also announced they're laying off 250 people, which may not sound like a lot. That's more than 10% of their workforce.
Yeah, it's a little bit of a mess, but some of us wouldn't have it any other way. It's good old Overstock. As an investor, it's more fun to watch than own, I'll bet.
So do you think there is a price at which someone buys the retail arm? Because it's not, I wouldn't say Overstock.com is a tarnished name in the eyes of consumers. It might be in the eyes of investors and maybe a lot of investors, but to the eyes of consumers, I don't look at that as a tarnished brand.
No, but what are you going to pay for an outfit that can return, $10 million in cash flow, operating cash flow a year, which is what they say they want to do in the retail unit in 2019? What's that really worth? Probably not growing $10 million in operating cash flow a year. Not free cash flow, operating cash flow. It sure ain't worth a few $100 million.
Let's move on to Lumber Liquidators, another fourth quarter report featuring a loss.
Yet another kick right in the what. Oof.
Expenses up 65%.
Well, they have a whole lot of bad stuff going on, right? So I put a lot of it behind them, right? Settled with the Department of Justice, now the SEC settlement, and another lawsuit. And so that's going to be $97 million total. Some of that's already, I guess, on the balance sheet. It's not all cash, but it's still a big number. It's another 40-some million. They've got the liquidity with borrowings to cover it and cash flow. They should be able to get it through. All this, you remember, comes because they were supposedly poisoning everyone with formaldehyde. And the little tidbit that you get in the latest call is that of 83,000 test kits sent out to test this formaldehyde exposure, guess how many of them came back as exceeding those World Health Organization standards for safety?
1%?
Zero. So you might say that this was much ado about nothing, except that the stock got killed because the brand got killed. And so it's still being killed. Nowadays, it might maybe should be called vinyl liquidators because that is the trend apparently in flooring, vinyl plank flooring, which I love, by the way. It looks like the what's the word I'm looking like the pergo laminate, it looks like that kind of stuff, but I think it's a little more durable. It's easier to put down. Price points are lower. Luckily, the margins are good, but they're selling a lot of that. But in the meantime, you got a pretty crummy housing market, not helping. Home Depot, not helping. Tariffs, you got a 10% tariff bite, maybe going up to 25%. I'm sure the folks at Lumber Liquidators are tired of all that winning. And in the meantime, you've got really not much top-line growth at all. You got some installation services growth, but you have a drop in merchandise sales and a drop in the comp. They're still opening stores. The story isn't good there, and I think they're trying to have a high-touch flooring model at a low price, and for a while they were doing great with it, and then everything fell apart, and maybe that's just not a business. Maybe you've got Home Depot, and maybe you've got higher end. They're trying to be higher end as well, but it's just it hasn't worked for a few years, which, my stock is way down, but sometimes things happen. Sometimes stuff outside your control happens, like somebody sues you and claims you're poisoning people even though you're not. And sometimes the business just doesn't work, and maybe we have both here.
When you look at Lumber Liquidators, and this is a stock that 5 years ago was around $100 a share. Today it's around $9 a share. It seems like there is a path forward, but they better get there pretty quickly, because I don't know how many more quarters like this. And even if you take out sort of the one-time legal charges, or at least
those are huge right now. Yeah. So that's one. You get rid of that, you should be able to eke out a small cash flow situation going forward. And they do a pretty good job selling this stuff when people come in the door, but folks aren't coming in the door for various reasons. It's the market, it's the reputation, it's all of those things. And so I don't see a lot of growth there. I still own the shares, but they're just in the deep freeze.
Two quick questions. One, is opening more stores the answer? And two, how badly do they need a rebrand? Because
Lumber Liquidator sounds like a terrible name, right? But people do know it.
Well, they know it, but if it made more sense when the business was lumber, and as you said,
it was never really that.
But as they move to, the vinyl option, maybe that's the move.
I don't know. I think you have to keep the name because that's all you have left. I don't know. I think it's just on a slow, very low simmer, and you see what happens. I certainly wouldn't be buying shares right now. Okay. It's tough for me to imagine that they're suddenly going to kickstart growth. But who would you expect to kickstart growth in this segment? And we had Tile Shop, right? That was another old hidden gems pick that was doing great for a while. Also just Flooring is a tough business, lots of competition, You're competing with locals or you're competing with Home Depot. And these chains that did well for a long time all just ran into a wall.
We talked a little bit about this on Motley Fool Money over the weekend. I wanted to get your thoughts on this. And it's presumably in the month of April, we're going to have both Lyft going public and Uber going public.
Hooray!
Lyft has, as someone who has to, come into a studio and talk every day, I'm saying hooray. I'm excited about this. Now, not necessarily running out to buy the shares, but from a content standpoint, I'm excited to talk about this.
Yeah. This is all we're going to talk about.
That's not all we're going to talk about, but it does. I am struck by the fact that Lyft appears to be, yes, Lyft is a smaller company. They appear to be a little bit more conservative in what they're trying to do.
1/4 or 1/5 revenue right now.
And Uber is looking to go public at a valuation of $120 billion, which
Lyft is looking for like 20-ish billion.
Yeah. And look, God bless the people at Uber if they earn the valuation of being bigger than Costco or being bigger than Amgen. But that also seems like
losing a lot more money.
Well, yeah. And also as investors who like to see a runway, and hopefully a runway that goes for a long time, it's hard for me to get excited about any IPO.
Already that big.
That's already that big.
It is tough for me to get excited about this business because so many others who have advantages along the lines of also being able to make cars have looked at this and said, we can't really make a ride service work economically, and they've gotten out of this business. And so you get this weird situation where you have large companies with some interesting technology and other advantages who are saying, we're not going to touch this. And then you have these companies like Lyft and Uber that have been burning venture capital for years, and everyone's all excited to plow IPO money into them. And the end of the cash burning is sort of nowhere in sight. And so, it's a pretty tough decision to make, I guess. Well, I envision them as sort of like running a race in a fog. You can't really see in front of you, and you don't know if you're going straight ahead and someone's going to hand you a wad of money that'll be great, or if you're just going to run off the edge of a cliff. That's what investing in one of these looks like to me. To talk about Lyft, who has the registration statement out, at least you can get a few numbers at this point. And riders and revenue per active rider has been improving nicely. You're looking at like 18.6 million riders, and they're just U.S., right? And $36 a rider. Their revenue is about $2 billion. Uber's revenue almost $12 billion in 2018, but they're both losing a lot of money, and those losses are getting bigger. And they're both trying to get into this bike and scooter thing, which has got its own challenges, not the least of which is, if nobody washes a rental car, you ought to take a look at what happens to these scooters. I read somewhere that the average life of those scooters was 45 days or something. So, hey, you environmentalists out there who are totally into that, if that's true, that is the biggest waste I have ever seen.
Can I just, let's put a pin in this for a second. Can I just say that, and we've got in the greater DC area a bunch of these scooter rental things
and many have already pulled out.
Well, the thing that strikes me about them is, not to sound like an old man, but the lack of helmets.
Well, you have to. You have to tell the app that you're wearing a helmet and that you know not to ride it on the sidewalk, which everybody does, and then they proceed. Yeah, apparently, and then they proceed to ride it on the sidewalk with no helmet. I have never not seen somebody on the sidewalk with one of these things.
Well, to go back to how we started this episode with St. Patrick's Day, yesterday going down the main drag here in Old Town Alexandria, a guy who looked and sounded like someone who had a couple of drinks on his scooter, not on the sidewalk, right there on King Street.
That's where he's supposed to be, at least.
One hand on the wheel, on the steering, and the other hand holding the six-pack that he was transporting.
Yeah, I have as a guy who builds a bike or two, I've never really liked scooters of any kind because they're really, really twitchy and easy to crash. So I have my wonder about what's going to happen with those. But, they're trying to get an encompassing ecosystem. And so while the goals that they put forward in the registration statement, speaking about Lyft here, sound laudable, at the same time, you've got, these Lyft is trying to democratize ride sharing. It's, one corporate dictatorship at a time is what came to mind today, because of course the founders are going to control 50% of the shares by having special shares that give them 20 votes. And everybody seems to just accept that, but it doesn't always work out great when your founders get to kind of do whatever they want because they fear no repercussions. I'm thinking about Under Armour. You had Kevin Plank sort of steer that business into the dirt. And you read later on that, he was making a rye distillery and he was, petting race horses and doing all this other stuff. When you thought, wait a minute, I thought you were trying to make Under Armour a better company. So not really a fan of those kinds of arrangements.
So is Lyft doing the move that Evan Spiegel did with Snap, where they're going to go public with dual class shares?
Got A and B, yeah. From what I understand from going through it quickly today, the founder shares will have 20 votes per share, and everybody else will get 1 vote, and that equates to roughly 50% of the voting share to the 2 founders. Somebody correct me if I'm wrong, but that's what I saw.
So Uber's...
It's not as high as some, I would say.
Absolutely. Uber has not filed their S1 yet, so we haven't seen their numbers. What is something that people should be looking for when that S1 comes out? Because that seems like documentation that a lot of people are going to want to get their hands on. And what is something, not necessarily like, this would be encouraging, but just like what are 1 or 2 sections of the S1 that people should check out?
It'd be interesting if they broke out a little bit better how these new businesses like the bikes and scooters, how much those are sucking out of the company, because there's a couple of pretty large companies, including like the largest food delivery outfit in China, that said we're not doing that scooter thing anymore, or bike thing, whichever it was. And I would be interested in knowing that, because I feel like that's a business that has to disappear eventually. I like seeing the dollars per rider. I think is interesting. What's missing is probably, and it'll probably remain missing, but maybe you can find enough clues is a roadmap to some kind of profitability. In other words, if you're getting your growth and the growth is still pretty high, but you're spending, if you've got $2 billion in revenue, but it's costing you $800 million in advertising, that's not sustainable over the long term. And presumably at some point you don't have to advertise the rush for members, or to kind of the market share grab will hopefully end at some point in time. But it shows no sign right now. The fight is still going on. And then you've got, in the future, it's easy to say, well, between them, they've already split up the market, right? There's a couple of small competitors, but, we're going to have a Waymo and some others try to come out with autonomous rideshare programs, which would conceivably get rid of one very large expense, which is paying drivers. So there's an entirely different kind of competition on the horizon. I guess you'd argue for Uber that, hey, they have their own self-driving car initiative, but I think they're probably in one of those last place positions there.
Thanks for being here. Mm-hmm. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.